Today we're going to talk about the road to investing your assets. Joining me today is Jim Pastor, our head academic. So Jim, welcome.
Thank you.
I'm going to ask you the question everybody asks me when they find out what I do for a living. What stock should I buy?
And that's the wrong question, Dirk.
I know that's the wrong question. Everybody asks it anyway, right?
Right, right. And they think, any given individual has a, insight into what the great investment is going to be for that year or for that time period. The important thing to understand, especially for most investors, is that you need to make sure that you don't have all your eggs in one basket. We had talked about the 4 asset classes in another interview that we had. And with investing, you need to diversify. You need to make sure
Absolutely.
that you have made several different types of investments in different areas so that you don't, live or die, based upon one investment. Sure, every now and then there's somebody who happens to buy the Microsoft or the Apple and makes a killing, but probably in much, much larger numbers you get people who work for a company and then something bad happens and they lose almost all, if not all, of their savings. So you don't want to put yourself into that position where it's an all or none proposition. So the way to do that is to make sure that you diversify and then you take sort of a balanced approach to investing.
Right. So my normal answer is you should buy lots of different stocks.
Right. Right. And the consensus tends to be, if you're buying individual stocks, at least 15 to 20 stocks, but diversified. In other words, you wouldn't buy 15 technology companies. You'd buy
Right.
technology, utility, et cetera.
Right, right. Well, what do you recommend for the average investor? Because really the average investor isn't going to go out and buy 15 to 20 stocks.
Right. And the average investor, first of all, you want professional management. You want somebody who knows what they're doing. You'd also like the benefits of diversification. And it's hard to get that sometimes, especially when you're starting, because you're not going to go out and buy just 1 or 2 shares of 20 different companies. And then obviously you want to keep your costs under control. And an easy way to do this is through mutual funds and also exchange traded funds. But mutual funds give you that diversification. You own a piece of the pie, and whatever that fund's invested in, you own your pro rata share. And that way you can get the management and you can get the diversification without having to actually pick the individual investments.
Right. So you talked about some of the pros of buying mutual funds. What are some of the downsides of using mutual funds?
Well, mutual funds, depending upon where they're held, if you have them in a tax-deferred account like a retirement plan, you don't need to worry about ongoing taxes. But if you hold them outside of a retirement plan, you could have capital gains taxes, dividend taxes on dividends, that sort of thing on an annual basis. The other thing is challenges with mutual funds can be, picking what's the right fund. And you need to do some research and educate yourself as far as what the options are out there, what are the fees, what are the funds trying to achieve. Now, there are all-in-one funds. There are funds out there for people who are just getting started, for example, that are balanced, that are in stocks, bonds, and cash. There are funds out there that are what are called target funds in retirement accounts that basically are a fund of funds with various funds in it, and they do the balancing for you.
Jim, we hear a lot about ETFs, exchange traded funds, which gained a lot of popularity the last decade. What are the pros and cons of an investor using ETFs in their portfolio?
Well, exchange traded funds have become extremely popular, still not nearly as popular as mutual funds, but there's a lot of money now in ETFs. There's good things and bad things about ETFs, just like with any investment. One thing that people point out with exchange traded funds is that they're easy to buy and sell. So unlike mutual funds, which are only priced once at the end of each day, you can actually buy and sell ETFs during the day when the market's open. So that can be an advantage if the market's really down or up at any given point in time, and you can take advantage of that. The downside to ETFs, though, for the long-term investor is that short-term trading should not be a concern for the long-term investor. In fact, oftentimes you have to guard against that, or you let your emotions make the decision, which ultimately leads to buying high and selling low. So the fact that they're more easily tradable, and ETFs also, there are some index-based ones that are relatively inexpensive and are very tax efficient, which is great. But there are also exchange-traded funds out there that are very concentrated in various industries and also leveraged 2 to 3 times. And these use derivatives, and these start to become much more sophisticated, more like speculative vehicles rather than investing vehicles.
So Jim, what are some of the common mistakes you see the average investor make?
Well, with financial planning in general, you have to have a roadmap and a plan. So what you should do is when you're investing is you should take into account your time horizon and realize that slow and steady wins the race. The people who don't make money or lose money in the markets are the ones who don't have that plan, who don't have that strategy. I always found it fascinating. Peter Lynch ran the Magellan Fund for years, and he was a top performing fund. I mean, he was consistently beating the S&P 500 by 3 or 4% a year. Yet over half the investors in his fund lost money. And you go, how could people invest in the top performing fund for a decade and lose money? Well, it's emotion. They got in, they got excited, then the market suddenly went through a correction,
yes.
and then they panic out and they lose, and then they don't get back in. Or if they get back in, they get back in at a higher price, which then stacks the deck against them, and it's a losing battle.
Right. You know, one of the things I see a lot is people buy IRAs, and they typically will buy them through their bank, and they're paying a very, very low interest rate. I think a lot of people don't realize that when you have or you purchase an IRA, you don't need to leave it in that original investment vehicle. You can move it.
Right. The way to think of an IRA, I hear people refer to IRAs all the time as it's they're this individual entity that whatever it's in, it's locked in.
Right.
An individual retirement account is an account. Think of it like a boat, a vessel. And then whatever you do in the vessel or the boat is up to you. If you want to buy stocks, you want to buy mutual funds, you want to buy exchange traded funds, you want to have it in a stable value fund, a target fund, whatever is fine. And then if you want to change your mind and invest in something else, you can do that. Now, I'm not encouraging people to be actively trading. I don't think that works. But realize you do have flexibility. So it's not like you're locked into something and then you can't make a change. The taxation occurs when money comes out of the account.
Right. Now, what about rollover IRAs? You know, it's more and more common for people not to spend, you know, an entire career with one employer. And some people may have 2 or 3 actual IRAs with past companies. Is it better to roll those over and have them together, or should you leave them where they are?
That's going to depend. Some people will have the money where it's at and they like the investments that it's in, and it's perfectly fine to keep it there. And there are some protections you have with what are called ERISA protected accounts, like 401k plans, in the event of bankruptcy and things like that, that you don't have to the same degree with individual retirement accounts. So there may be reasons from a creditor standpoint that you want to keep it where it's at. But in general, if you're looking at investment options, you know, with an IRA rollover, you can consolidate accounts, and you can also typically have more choices as far as where to invest. But again, with the caveat that, you know, just because you have more choices doesn't mean you should be there, you know, actively changing how your account is invested.
Right.
You need to have
with
a strategy.
maybe the exception of rebalancing.
Yeah, rebalancing or things like that,
right.
Certainly.
Okay. You know, what about retirement plans? I see a lot of people who, well, maybe not a lot of people, but there's a good percentage of people who don't take advantage of their employer-sponsored retirement plans. And we're going to talk a lot more about that, but I think that's one of the big issues. Wouldn't you agree?
Yeah, that's huge. First of all, I think people underestimate the value of holding on to $1 as long as you can. I mean, if you earn $1 and you're going to lose, let's say, 20 cents on the dollar to taxes or more, you know, if you put $1 into the retirement account, the 401k plan, then that's 20 extra cents or whatever it is that you've not only held on to that you would have lost, but now it's going to earn interest or return or whatever for you. And over years and compounding, that can make a huge difference. The other thing that people have to realize is there's a lot of employers out there who do matching contributions where that's an immediate return. I mean, if they match 50%, that means you put $1 in, you now have $1.50. You're not going to get that anywhere. I mean, an immediate return such as that. So individuals, a lot of people say, I can't afford it. I'm living paycheck to paycheck. But that, again, that's part of why financial planning is for everybody. It behooves people to figure out a way, even if you can't put everything you want in there, start small, but get in the habit.
Well, even, you know, one of the tricks we talk to people about is, you know, you got a 1, 2, 3% pay raise this year, put half of your pay raise into it every year.
Right. People don't miss the money if they get in the habit of this is what my take-home pay is. They've done studies. In fact, now they have employers where you have to opt out rather than opt in. And what happens is the employee starts with a firm, and right off the bat, 3 or 4% is going into the 401k plan. And what they found is people, if they start at the beginning, they don't miss it.
Right.
And then they get in the habit, and then they start seeing the account balance going up and the progress they're making, and it becomes a habit then. It becomes
right.
something they want to achieve.
Right. Well, great. So today we've talked about the road to investing your assets, and really the key things are, first of all, be conservative, not necessarily conservative in what you're picking, but start with mutual funds. And, in your retirement funds, ask for advice if you need advice, but start doing it. I mean, that's really the key to investing, right?
Right. A step at a time. And
One
again, a
step at a time.
process.